Welcome to ETF Leaders, powered by the New York Stock Exchange. I'm Judy Shaw. Joining me today is Nancy Davis. Nancy is the Portfolio Manager for IVOL. Nancy, thank you for joining me.
Thanks for having me.
So Nancy, let's talk about IVOL. Last week, IVOL traded close to 2 million shares. Tell me why investors like IVOL.
So IVOL is a U.S. government bond fund with a interest rate volatility and inflation hedge on top. It's a very liquid portfolio, and I think what we saw last week was lots of trading activity for an ETF that's relatively new. We listed on the New York Stock Exchange in May last year, so it's about 7 months old. I think it's fabulous to see how much liquidity the exchange provides for fixed income investors.
Now, how are investors using IVOL in their portfolios?
So most investors are using it as a fixed income replacement. So if they have a passive allocation, they're using it to diversify and complete that portfolio. Many investors are also using it as an equity tail hedge. Since IVOL is long U.S. treasuries, long fixed income volatility, meaning we benefit from market stress, and we also profit from the expectations of rate cuts from the Fed, and that typically happens when equities sell off and credit spreads widen. Some investors use it as a way of diversifying equity. We also have some investors that use it for min-vol or low-vol portfolios, because if you look at why investors are buying that segment of the market, they're usually looking for income, and they're also looking for a more defensive portfolio. IVOL is not just low vol, it's actually long vol. And then last year we paid out over 6 months, 2.02% was distributed to investors. So, that was over a 6-month period, but annualized that's over 4%, which is comparable last year to the annualized yield of high yield bonds. So it's got a nice potential for enhanced inflation protected income, but also is a defensive portfolio.
Okay, and now in your opinion, what do you think is the greatest risk for 2020?
So I definitely think investors are being quite complacent about listening to the Fed, and the Fed is talking about normalizing inflation expectations. And everybody hears CPI and looks at CPI, but what really matters for investors' rate, credit, real estate, private equity exposure is inflation expectations. And inflation expectations are on their floor. And you see that from the US yield curve. Like, think about it, if I was lending you money, why would I lend you money, if I give you a 2-year loan at, X percent, say I charge you 3% because I think you're a good credit risk. And then you say, no, I really need that money for 10 years. And then I say, okay, I'll pay you 3% and 10 basis points. And that's where the US yield curve is. It's around 10 basis points right now. And that's because universally, everybody thinks there's going to be deflation forever. Bonds are bid forever, deflation forever, and therefore taking a contrarian view is really cheaply priced. And the really neat thing about IVOL is we don't need some tail event to happen to make the strategy work. We just need a normalization. In 2013, the US yield curve had 2.5% difference between front-dated and long-dated yields. That was not some crazy thing, right? That was a normal environment. That was what people would expect, that you get paid 2.5% more for lending money for a longer period of time. Now, because there's no inflation expectations, that's so cheap, I see it as a real value play. And the Fed is talking, if you Google Powell, and every time he cut rates last year, he kept talking about inflation expectations are what drive actual inflation. So I think that people are missing that, and it's a really exciting time for IVOL because that's what we deliver to investors.
Wonderful. Nancy, thank you so much for joining me here at Insight ETFs.
Thank you. It's a pleasure to see you again.
Too. And that's ETF Leaders, powered by the New York Stock Exchange.